group. We welcome everyone to this panel discussion on investment and acquisition. So as you remember, the last one we had on scaling up, it was well received, and a lot of our members commented that it was very useful. So this was the top among the other topics which were suggested by everyone, where people wanted to hear about the experiences of our fellow members who have already gone through this journey. So I think we have had we have to put a lot of effort in bringing this panel together, which is a mix of services companies, product companies, and mix of experiences as well. And we were also fortunate enough to have a very apt panel for this and a very apt moderator. So I welcome Suri Amarnath from Thoughtline Technologies, who will be the moderator for today, and he'll be introducing the panel and taking the discussion forward. So once again, thanks everyone for joining today, and thanks in advance for all the panelists and the moderator. Over to you, Suri.
Thank you, Harish. Welcome everyone, and thanks to GTech for organizing this session on investments and acquisitions. It's a very interesting area which I think every entrepreneur at some point of time looks forward to, and who better than people who have already gone through many of these situations in real life to talk about and give us their experiences. So today we have a wonderful and diverse set of panelists who have, as I mentioned, gone through quite a few scenarios, probably different scenarios, and I'm looking forward to actually learn from the session, from their experiences, and I'm pretty sure that's the situation with each and every one of you. So when I say diverse mix of panelists, we have for example, near unicorn from Kerala. We have a company which is totally different from a normal run-of-the-mill IT mix and has gone through 2 acquisition cycles. We have someone who's been in the service industry, started from scratch, and made a successful exit. We have another person running an operation from grassroots, went through Kerala Startup Mission, and is a success story from Kerala. So I will let each of you to figure out who is who in the course of the session. But let me welcome the panelists here. So in the I would say alphabetical order, let's go. Vishnu, next slide. Yeah, Arjun Satheesh, who heads the operations at Carestack. Most of us here in Trivandrum and in Kerala will know of Carestack. So, Carestack has been a huge success story over the last 7 or 8 years. And, we've been watching them from a distance. Today is an opportunity to get to know a little bit more in detail about them. Welcome, Arjun.
Hi, Suri. Thank you. So,
Vishnu, let's move to the next one. Yeah. We have Gautam Shankar, who is the Vice President of India Operations, Kimball Electronics. Gautam has been involved with GTech for quite some time, I would say for the last decade or so. He's been part of Kimball in various shapes and forms. And Gautam can provide some perspectives of a non-typical IT operation in Kerala IT scenario. Welcome, Gautam.
Hi, everyone. Thanks, Suri.
Okay. Vishnu. Mohammed Faizan Lanka is the co-founder of OfficeKit. OfficeKit has HR products which has been incubated at the Kerala Startup Mission, and they are implemented across 20 plus countries, 40,000 users, and they are based at Cyberpark, Kozhikode. Welcome, Mohammed.
Thank you, Suri. Yeah.
Vishnu. And finally, we have Deepu Zacharia. Deepu is a familiar face for, I would say, everyone in Kochi. Deepu is also the president of India Operations RCG Global. Deepu started his journey in 2012 as a typical IT service company, and he went through an acquisition in 2019. So Deepu, we are looking forward to hear from you.
Hey, thank you, Suri. Pleasure to be here today.
Okay, so Vishnu, we'll come to this later. The next, I would say, if we can go through each one of your stories, let's take a few minutes to hear from each one of you, maybe starting from Arjun.
Sure. Hi, everyone. So I'm not sure how much familiarity everybody has about Carestack. We have consistently tried to maintain a low profile. I'll try to be very concise and give a high-level idea about what we are trying to do and our funding story, right? So Carestack is what we call vertical SaaS, or what is called as vertical SaaS, because we are an all-in-one software as a service platform, very specifically for one single vertical, which is US dentistry. It's a very focused, very niche vertical, but we chose that because there existed a large opportunity there, and the market was fairly large. The US dental market is a $143 million market. Sorry, $1 billion market. So we picked that up as our as a great opportunity, a very non-sexy problem, but a very valid and a very economically important problem to go after. So that's how we started Carestack. We started Good Methods Global as a company in 2015. We pivoted to start building Carestack from 2016. And since then, we have actually gone through 5 rounds of funding to raise 60 million till date. And we are actually going through another round of funding as we speak to try to basically put together our CDC. So that's a very high level overview. Just to add one more point, what we are trying to do is how we are looking to grow and looking to to obtain a market leadership is by a very aggressive deployment of capital. So that's kind of why we are raising a very aggressive amount of capital, because the market US dentistry is a market that is held by very old, decades old public listed companies who are not core technology companies. So we are trying to disrupt a market which is currently held by non-sophisticated but extremely large players, and that's why we are raising. We are going, on a very aggressive mission to disrupt that by a very aggressive deployment of capital in that space. So that's a very 30,000 feet high overview. Is that helpful?
Okay. Thanks, Arjun. Next, Gautam, you want to go ahead?
Sure. So hi, everyone. Let me quickly tell you what Kimball Electronics is. That is where we are at present. So Kimball Electronics is a large EMS company, or an electronics manufacturing solutions company, and is listed on the NASDAQ. We, as Kimball Electronics last year, I think had a revenue in the range of $1.3 billion. And so today's is about acquisitions. We became part of Kimball Electronics through an acquisition that Kimball made in 2018. Before that, we were known as GES. And GES is in the business of manufacturing automation, primarily manufacturing automation, and we service areas such as consumer electronics or pharmaceuticals and automobiles. Now, so that was a good acquisition. I think that's what primarily we're going to talk about today as part of the discussion. But before that, in 2010, GES acquired a company called Wins Infotech, which is what we had started from as a small incubatee in the Technopark Incubation Center in 2005. So 2 acquisitions to reach where we are today, and hope to have a good discussion. Thank you.
Thanks, Gautam. Mohammed, can we hear from you?
Good evening. Myself, a founder of OfficeKit HR. OfficeKit HR is an hard to retire product. Okay, we founded this product in 2018. We started our journey basically pitching to a lot of investors, and we started our journey. We got investment raised from Kerala Start Mission first. From there, we started our journey. Right now, we have implemented this HR product across 20 plus countries, mainly in APAC region, MENA region. And we have almost 40,000 users on our platform. And yeah, we are based out in Cyberpark, Kolkata. So I think we'll come up with details in question as well. Thank you for that.
Okay. Thanks, Mohammed. Deepu?
Hey, good afternoon, everyone. So as you all know, I'm based out of Kochi. A little bit intro about myself. I'm a software engineer by profession, and I've been in this industry for the past 18 years or so right now. Though it says, the company was the company which was called TA Technologies was established in 2012. I do have a few more years behind me, which is basically like the Apples and the Microsofts and all, wherein it was just an idea in motion, and we formally conceptualized the whole company thing in 2012. So established in 2012, running out of Infopark Kochi. We were a services company catering to different parts of the world, as many of us over here would have done, traveled around the world trying to acquire customers, talk to them, network with them, try and understand how the industry is, mature my business, mature the service model. And then finally, after all the pain and the joy that I've experienced, there comes along my current partner, which is RCG Global Services, who, expresses the interest of, acquiring us back in the July of 2019. And then, sorry, the date is wrong here. It was March of 2019. And from there, I had a good journey for the past couple of years, and very happy to say that, there is another acquisition at the group level, which concluded on the 31st of October. And I'm a part of a new company, a new group right now, running out of Islin, New Jersey. And I'll be happy to expand more on this this journey that I've embarked with all of you guys today. Thank you.
Okay. Thanks, Deepu. Vishnu, let's move to the next slide. Thank you. So what we have done is, we're trying to structure this, panel discussion on certain topics based on the feedback that we received from people who are present here. So we'll go through them. We'll talk to the panelists. I would say it won't be a round robin kind of thing. It'll be like, whatever any of you can add to it, please feel free to talk about it. And then finally, we'll open up the session for question and answers. So starting point, one of the questions was, why should a company go for an investment, right? What are the motivations? What are the advantages of getting an investment? Acquisition comes later, but we're talking about investments. And how do I choose an investor? My take will be, sometimes the investor is the one who chooses you, but still, how do we go and choose if there are multiple suitors present there? And what kind of investments are there? Is it a growth based investment or a buyout, which is an acquisition kind of thing? So we know that our panelists all have diverse experiences. So I think we'll start with Arjun. Arjun, you touched upon it a little bit in your introduction, where you said, in your industry, it is a very capital intensive industry. So I would say it's a no-brainer to go for investment, but we'd like to hear from you. what are the other factors that determine that?
Sure. So, I would think about businesses as two kinds, right? So the first is that is there a large upfront cost, or is the cost, is the investment, and is the asset creation upfront, or is the asset creation parallel, right? Now, end of the day, bottom line is what everybody's after. So if there is an opportunity to not invest upfront, or deploy capital upfront, and essentially keep your bottom line up from day one till the end of the life cycle, that's the best possibility, right? But for product companies, or for companies in certain market that requires a significant amount of upfront investment, whether that is in terms of technology creation, investing in the market, investing in brand equity, all of that, the investment, and pretty much in all product companies, the investment is pretty much upfront, right? And then the question is, in what time do we tide over that investment, both at an organization level and at a unit level, whether it is by a customer or it is by a technology? How do we overcome that upfront cost and tide over that, right? So that's kind of how we think about investment. So in our case, we raise investment because we have to build a stellar world-class product in terms of technology investment. We have to invest quite a large amount of capital in the market, because it's even though it is B2B, it is still a very saturated market with already existing competition that we have to overcome. We have to invest in brand equity, right? We also have to have a very significant upfront investment in capturing our customer base. So those are the three large things we see as a very large upfront cost, which we feel it takes almost a decade to actually overcome. And that's our reasoning of going behind an investment as a product company.
Okay. Yes, as I said, and thanks for clarifying it, Arjun. From a product company perspective, it is absolute must. Especially when you're dealing with in a field where the competition is so high and the costs are so high, the funding is important, paramount. What are some other factors apart from funding that can come into play when an investment is looked upon? And Mohammed, do you have any experience to share on this?
Yeah, I mean, let me just add to the point. Like when we were building the product, OfficeKit HR was basically a hire to retire tool, okay, which was very large product, which was in fact enterprise product. Initial days when we were building the product, we were not able to grow at the pace, which we were trying to. There were a lot of opportunities in the market. However, we were short of funding. So that was the time, we actually thought we need to raise funding. So when we raised the funding, the easiness which we got, the leverage where we got was, we were able to do proper branding, proper marketing, increase the size of the team. We were able to invest in research, and simultaneously we were able to grow. So these were the things which we actually got while we received the investment, and I think these are things which help us to grow faster. That makes
okay. Yep.
Yeah. So Suri, you want me to touch base on the second question here? How do you choose an investor? I can give some perspective of the recent exit that we did.
Please, Deepu. Yes.
All right. So let me share with you guys a little different perspective of how a services company would actually look at investments, right? So ever since I joined RCG, which is a semi-enterprise kind of company, and we service the Fortune 100 clients out of US. We are owned by a PE company for the past 7 years or so, and as you know, as a PE investment company, they always look at their return on their investment in the 5 or 6 years time. But a bad patch hit us in 2020, wherein the pandemic hit us and the business took a U-turn, and there were like a good, sizable amount of difference in the bottom line. So we went into the market in early 2021, looking out for investors to basically pay back the PE company, the payout back to the previous PE company, and then choose a new investor into our company. So how did we do it? We took the advice of investment company who would basically introduce us to potential investors in the market looking out for sizable investments in the tune of what our company was looking for. So we were given an opportunity to meet and greet at least 30 different companies and pitch to them about the service value that RCG as a company would actually bring about to the service industry in the US, right? How did we do it? We did this through a pitch deck. We created a complete portfolio of what the company is, what the financial situation of the company looks like, what are the potential customers that we service today, and where do we go from here? So using all this, we basically gathered expression of interest from these potential buyers out there in the market. Initially, we were given about like 14 different companies who basically expressed their interest to bid for investment at RCG. The second round was all about bidding and close bids, which was tied to a date. And once the bids came in, we narrowed down to 3 different companies who were given exclusivity to actually go for the next round, which is basically the due diligence, which will take up a good amount of time to understand what the business is all about. And this due diligence was basically tied to a period, which is about like I think it was around 90 days time, wherein they had complete freedom to dive into the business model that we have and try and validate all that we had actually proposed to them. So all that exercise moved from 90 days to 120 days and beyond. But then the end result is that one of them came out as an emerging winner, and the company or the investment firm who basically introduced all these clients to us were called Clearsight Advisors, and they are potential matchmakers of these investors who would want to invest in companies like ours. So giving you guys a different perspective of how investment comes in from a services company or we.
Okay.
Suri, I can add something a little bit here. Did you have
Please,
some
Gautam. No, go ahead, Gautam. That's what we are here for. We want to hear from you guys.
Yeah. So I want to share a little bit of experience in my early days around 2005. And in 2005, when we started, things were looking pretty good. And I'm talking about so we being in manufacturing and a little bit of hardware, stuff like that, it requires investments in factory facilities and so on. So what we did sometime in 2005-06 was that we had to expand some facilities. This was putting up a small factory in Japan. And we did that through a debt financing model. So the market business was looking really good. We had an excellent projection, and we decided that we'll go with some debt financing because everything was looking so nice and rosy. But in 2008, the Lehman Crash happened. And that was a time when we had a few $1 million of debt financing for setting up this small factory. And when this Lehman Crash happened, the entire, the buyers, everybody evaporated. There was nobody was buying anything, and capital investment was practically dead. And that was a huge shock for us, resulting in actually that whole operation folded in, and in those, it was in a little bit of that bad time that we went for this next GES investment into Wins. Now GES was an interesting, so GES had done a similar financing for their for setting up a factory in Vietnam, which is also a few $1 million, but GES went the VC route. So GES found venture capitalists, and the investment in that factory in Vietnam was VC investment. And from 2010, there were 2 or 3 years where we did not have significant business. We had a nice factory in Ho Chi Minh City, but nothing much was happening. However, because it was a VC investment, the stress on us in terms of the business getting a little delayed and all that was not as much. And as a company, we were able to leverage that and then grow from that point on by investing in sales, marketing, finding the right customer, stuff like that. While the factory, which was built and ready, did not put so much of pressure on us. So just that, trying to address that question about why should you raise investments and what are the other alternatives. So just wanted to touch upon that for you.
Okay. Let me ask, if any of you have thought of an investment as outside of funding as a mechanism to expand your network or to bring in some expertise that you lack in the market.
So maybe I can
Yeah.
take some of that. So we have, when we select investors, and I think your second question is also that how do you choose an investor? So we have considered 2 questions, right? One, is this incoming investor a good fitment for a good financial investor, right? So most of our investors on our cap tables are financial venture capital funds. And so the first question that we've asked is this a good investor? And in the sense, we classify that as being able to understand the business, being able to participate with us and work with us. And this goes to both institutionals and non-institutionals. A good example is Amarnath, who's been one of our early investors, who has worked very closely with us. And I think Amarnath is very well known in the space. So is Babu, right? So is this person or is this fund, will they work with us? Do they understand our goals, and do they understand what it takes in terms of time and in terms of giving us the time, but also in terms of pushing us, right? Now the second category of investors that we have looked for, and we have a few of them on our cap table, is people who can contribute to our growth. So our perspective in this, our largest example is Delta Dental. So Delta Dental is the largest dental insurance company in the United States, with pretty much every dentist connected to their network. We similarly have a large dental distribution company in the US participate in our funding round as a strategic investor. Now, one of the reasons that we have taken them both is that we can still work with them without their funding, right? We can work with them to achieve mutual commercial goals with mutual interests. But when there is investment involved, when either we are investing in them or they are investing in us, in this specific case, them investing in us, there is a very large vested interest that has now been generated. So it's not just about a commercial partnership working for their benefit. They are now extremely vested to help us grow, and it has actually reflected in certain growth initiatives that we have, right? So that is one primary reason for what we call strategic investors to come in, who have been within the, in our case, within the same industry. The other reason why we would think about that as an exit strategy, like will somebody within that investment, somebody who's investing, will they directly or indirectly lead to a exit at some point of time by virtue of their size and by virtue of common goals, right? Or by virtue of somebody else who has common goals between both of these investments, both of these companies. So, but we have not participated in any such transactions yet. But yeah, that's one way of us looking at strategic investors.
Okay. So I guess it's suffices to say that investment not just brings funding into the mix, which is very important, but also the fit with the company, the mission and the vision of the founders, or where the company needs to be in a few years down the road, as well as the network that it brings in and the expertise. So thank you, gentlemen. Let's move on to the next slide. Vishnu? Yes. Okay. There is a good level of interest in finding out what are the characteristics or factors that makes a business an investment magnet, right? So can you gentlemen, please share your thoughts on this? What attracts a business to potential investors? Arjun, it's an easy question for you, I think.
Sure, I mean, yeah, and I can touch upon this from our perspective. See, so again, as a product company, it's pretty standard, right? So from a potential investor, what they're looking from a product company are we solving a sizable problem? Are we looking at a sizable market problem? So I'll just take an excerpt from a quote from Ben Horowitz, right? So what his investment philosophy is that for an institution to make sense, for a fund specifically to invest, and for it to make sense, each investment within a fund, so a fund can have 10 to 20 investments in it at least, right? But the philosophy is each one investment should give, if it succeeds, should give the return from the entire fund because of the high risk, high reward mechanism. Assuming only one of them will succeed, all the rest will fail, that one investment or each investment should give the return for the entire fund, right? So from a product venture capital investment, they are looking at a very, very exponential outcome for an investment. So for that to happen, it has to be a sizable problem with a very, very large total available market. And for this specific product or organization to have a very, very sizable chunk of that entire market, right? So if I have to just put it in one single line, that's the defining characteristic of a successful product investment.
Okay. For a product in a sizable market, which addresses a major problem and solves it. Right. Deepu, from a service company point of view.
Yeah. So from a service company perspective, drawing into my experience, and I have a little different perspective of looking at it. Why did RCG as a company look at TA Technologies as a potential acquisition target, right? There were multiple reasons behind this. One of the reasons being the fact that RCG did not have an Indian presence out here. Now, many of you guys would actually ask, why should you acquire a company to have an Indian presence here? Why can't they build something out of the box and start running with it from day one? The answer is quite simple. We've had a previous history with this company. We had been with this company for about 2 years until when this company thought that okay, TA Technologies is a sizable good target to get acquired. One, two, the fact that the kind of the kind of marriage that we already were in as a business entity was very was very attractive for RCG as a company to get involved in an acquisition with TA. The reason being the fact that they enjoyed working with us, they enjoyed the quality, they enjoyed the composition of the team, and they also enjoyed, the kind of business relationship that they had with me as a entrepreneur. All this made it quite very simple as a plug and play module for them. Buy it off the shelf and start running from day one. That's what they looked at. And from a different perspective, when you look at it, not many of these acquisitions go and reach the finishing line, right? Some of them do fall off along the lines, and some of them do make it to the finish line. And some of the major reasons contributing to this is about the fit that you basically get within this this marriage that you go or embark on. And it is very important to actually create that mix and fit. The culture needs to align. And as you know, when you are getting married to a company like this, the culture always does not fit, right? But how fast can you get aligned to the culture? How fast can you get working alongside them? How fast can you integrate into the larger business model that you're integrating with? All that matters more in the post-acquisition phase, where you basically start blending into the system. So for us, these were the different experiences that I've had in terms of being an acquisition target for a company like RCG. Sorry.
Okay. Thanks, Deepu, for the detailed explanation. Mohammed, Lanka, do you have something to add to this from your perspective?
Yeah. As OfficeKit is a product company. So as you said, the major thing which investors were looking at, it was, size of the market. So that was the first thing, as any product company, we also faced. Second thing was, the traction you had on your product. That was the one thing which every investor was looking at, the validation of the product, how many initial users you had. So in fact, we started raising our fund, after building the product, after our product was ready, and we were in the market with few of the customers. So these, traction was very important for us, and I think these are the two things which I want to add.
Great. I'm not sure if you guys are hearing some disturbance, but I'm in phase 3 Technopark right now, and there is some drilling happening either above us or below us. So that's why I'm muting my mic here. Okay. Gautam, anything from Kimball's point of view?
Yeah, I can. Yeah, definitely, Suri. This is every acquisition goes through. It has to be attractive, right? So for Kimball, when they acquired GS, I think there were a few points. One point Deepu mentioned, they did not have presence in India. I think that was an important one for them. Vietnam also did not have presence, GS had. So that was another. So they were getting into actually 3 geographies, India, Vietnam, and Japan through this acquisition. So that was one interesting thing for them. But I think the most important thing was that they were looking to diversify, and they had a few ideas about what was important, what they considered important as the next step in their journey.
I think Vishnu, can you mute Ramesh?
Yeah. So they were looking at a diversification, and they had a few ideas about where they wanted to diversify, and that was a good match in terms of technology, in terms of geography and others with what we had. So I think being in our case, what worked was that we were in an area that was very futuristic, which was which had a lot of future potential, and that helped when we pitched or when we had our discussions with Kimball. So those are, I think, 2 important things that there are a few, of course, there are other things such as the assets that we owned or how they felt the financial model would work, etc. But I think these two are very important things that attracted them towards us. And the third one was some really good customers in our portfolio. So those were, I think, three things that were in order of importance, very important for them.
Okay.
Yeah, and Suri, I also want to add one more item here, right? And this is for all the budding entrepreneurs out there in the market out there looking out for investments or acquisitions, right? When somebody is trying to acquire or invest into a company, you're potentially looking at people looking at buying you, right? All the secondary items like the company, the balance sheets, the assets and everything takes a secondary stage. The center stage is you, right? You as a person who actually built up this empire, which is of value to companies who are looking for investment and acquisition. So all the entrepreneurs out there, you are valuable. Your skill set or your capacity to do things is of bigger value, and you become the center of attraction for people trying to acquire you. So it could be a singular person, or it could be a group of people who would have started off a company or a product or a services company. So people matter a lot. Just want to add this in.
You bring up a good point, Deepu. So it's not only a good product and a good clients, and a good solution to a problem, but the people add value, and especially the founders are the key people at the top. They are also looked upon as a key, what should I say, acquisition resource, right? It's not just the physical, other and intangible resources of the company, but there are some intangibles also. Vishnu, can we move to the next slide? So what are some avenues that we can look at to find potential investors, or acquisition candidates or acquirers? We know that, it's not a one size fits all kind of scenario. But that's why we have a good mix here with product companies and service companies, who have gone through different environments. So if we can talk about your experiences in this area, it will be very helpful. Who would like to go first?
Sorry, if you want, I can go for this, right? I briefly touched based on looking out for potential investors in the enterprise space, but I also know that there are opportunities out there in our domestic market where there are potential investors out there in the market looking out for sizable companies, right? Sizable service companies or product companies. But how do we get to them, right? In this market, in this Kerala market that we have here, right? What are the right methods to actually hit a good investor or a investor block that could actually introduce me to the right persons? Now, my experience so far, and I might be very limited, the rest of the panel might have more experience in this, but then my experience so far is that, we've got good trusted, investment partners out here in Kerala, spread across Kochi and maybe Trivandrum as well. Some of you guys who had actually reached out to me personally had actually shared with you guys as to what my journey was and how I found out my, my discovery process in finding out, the market. The right fit is to actually find out the right M&A partner for you right now first. The M&A partner basically has a good network of availability of potential investors looking out for potential opportunities in the market. They would give you a bird's eye view of what the potential targets are and where they are looking to invest, and you would probably have an index of people who who you would want to get introduced to. I would say from a Kerala perspective, which is a very early market in the investment world, this is the best way forward. Other than that, we have got those government instruments wherein we could always jump on the bandwagon and try out different for the product companies, for the different angel investors and the VCs out there. Anyone else who want to add into this? Yes, or
So yeah, I can add on how we would view that. See, the most common and the most visible things out there are things like Deepu mentioned, the whether that's government funded incubators, but also organizations that are built around startups, right? Or expect startups to help startups. So incubators, accelerators, all of those things. That provides a good starting point for very early, bootstrap staged startups to actually explore, right? We have not gone through something like that. I have in my previous lives, but not in Carestack. So that's a very conventional avenue and something that's very visible. And from there, we look at reaching out to VCs directly, or reaching out to VCs or seed investors directly. There is angel networks, like I think Kerala, there is a Kerala Angel Network recently that has come up, but there's also other investment networks available. So that's visible, but that's also very that does not give us a pre-qualification, right? Because the number of leads that are reaching are extremely large, so it's a very saturated way of reaching there and not very focused. A very focused way would actually be, like again, Deepu suggested, to use somebody like an investment banker, but I think that comes at least a Series A stage, unless there is a very, very potential product idea available. For a very good investment banker to participate, there needs to be a very strong reason for the investment banker to also be part of that transaction, right? We actually have used we've used investment banker in one of our transactions, and they have worked out really well for us at that point. So that is one way, because they help pre-qualify you as a product and you as an opportunity, the startup as an opportunity, and essentially use their network to bring that up into their into the VCs and investors they are very well connected with. So there is a brand equity that they actually give us, especially in a very early stage, right? At the same time, they also do a fair amount of vetting to begin with. The third, and this is where I think we have, after our initial rounds, we have never gone out and quote unquote raise funds, because most of our interest, and this wouldn't be really conventional especially in a Kerala setting, but how we have raised all our rounds after Series A has been inbound. So using our existing network, and more than anything, the network of our existing investors, we have positioned ourselves for other funds to be able to come out and reach out to us, right? And that is not, I don't want to give any misunderstanding that is going to be any easier. It is not. It's, we still go through the same grind. We still go through the same amount of, very deep due diligence and, pitching mechanisms and everything. But the good thing is there's an inbound interest. So we are not pitching to a lot of people. We are pitching to a very focused group of investors who have expressed interest in the market and in the opportunity, provided we are right. We are doing it well. We're doing our job well. We are doing it in a philosophy that has alignment, things like that, right? So these are the three very large buckets that I would think about investments in. One is a conventional reaching out, networks, all of that. Second is the investment banker or partner route. which would be, I think, which again would not be a seed stage thing. It would probably be at a later stage thing. And so is inbound. Again, once we have a sufficient network built, how do we position ourselves for existing investors to reach out to us?
Okay, that is quite useful, Arjun and Deepu. Mohammed, would you have anything to add to that?
Yeah, I think like my journey was pretty, from very basic stage. We started our investment journey from Cafe Startup Mission itself. In one of the cafe meet, we had to meet with one of the consultant based out in UAE. So he was the person who actually recommended to one of the accelerator program in US. So we pitched our product, and they were ready for investment. And as Arjun said, from that accelerator program, we got connected with hundreds of investors. So in initial days, we were almost pitching, daily based, 5 to 6 investors, and they were, these accelerator program actually helped us to connect with at least 100 of investors. We profiled a lot of investors who are actually fit for our industry, which what we are looking at. So that was one way which we actually reached to investors. Second way, it's very traditional. We used to have list of investors. We connect using LinkedIn. We normally send our 1 minute, pitch on the LinkedIn, and we used to connect, and we had a lot of connect with investors through LinkedIn also. We in fact had a lot of other sources of reaching to investors, and we did personal emails to these investors. I feel these are the 3 areas which we actually got connected with investors at the in this initial stage.
Okay.
Yeah.
Thanks, Mohammed. Vishnu, can you move to the next slide? So now we come to the valuation models and the criteria for valuation, which we all will agree is a huge can of worms, right? So, at a very high level, we are looking at product companies versus service companies, and every business, how it's valued. It is a practical problem as well as a sentimental problem also. So, but our panelists have gone through some of these challenges. Let's hear from them, keeping in mind that, again, this is just, it varies hugely from company to company, the kind of value you bring, whether it's product or service, and how badly the other party wants it also. So, Deepu?
Yes, sorry. Okay. So for me, as a services company, we've never thought about valuation, right? I mean, this thing did not hit my head, if I may put it this way, right? So when the whole acquisition letter of engagement hit me, right? The second thing that I basically thought is, okay, what is it that I will get if I sell my company, right? So there comes the question, valuation. How do you properly value your business and understand what your value is all about, right? So the obvious question for anybody like a homegrown company like mine, right, and many of you guys will agree with me, is that we'll talk among ourselves, right? And we've got good friends here within GTech who we can actually pick up your phone and talk to them and try and understand, okay, hey man, somebody's trying to buy me, right? What do I ask them? How do you think I value my company and stuff like that? So the answer that I got out of my good friends out here in this industry is that, okay, you should probably be asking for maybe 5 times, 6 times, or maybe 3.5 times, So I've got different answers, right? Which puts you in a different state of mind, right? You start, multiplying your numbers, and then there's a big star around your head, and you go happy, a big smile comes on your face and stuff like that. But the reality is totally different, folks. This is what I would like to share with you, right? So the industry standard is something that is accepted worldwide, and that is what we'll get, right? And what is an industry standard? There are different methods out there, right? So the right after I started talking to my guys and understood what they was trying to speak to me, I had to validate whatever they were saying against an expert to understand, where I stand. So the best way to do this is to seek the blessings of a proper investment firm or an advisory board to get the right information out, right? So I spoke to some of my peers out here in Kochi who basically came on board as my M&A partners later, who advised me and gave me the right picture that, okay, don't bring up that whole fairy tale land in your mind right away. That's not the way it works. First we'll have to assess your business. We'll have to start looking at your balance sheets. We'll have to start looking at what kind of future turnover you have. What is the kind of pipeline of businesses that you have? What are your gross margins? Based on which we'll basically come out with a valuation methodology which is apt for a company of your size. So then the pain started, wherein we started dissecting everything on a granular level, one by one. First, the first and foremost important thing was to actually take up the balance sheets of the previous 3 years. And I would say many of us here will not paint a very pretty picture if you look at the balance sheets, and it's very critical. And I'll put a period here and say that it is very critical that we take this as a very important point, that our balance sheets will paint the picture of your valuation, right? And it is very important to see that we do not have anything that is negative on your balance sheets going forward, which will basically put your valuation down, right? It has occurred to me. Let it not occur to my fellow entrepreneurs here who are aspiring to be acquired. Two, beyond the balance sheet, there is always a gross marginal impact in terms of the business that you do with your clients out there, which matters a lot, right? The gross margins that you would probably make on a client versus another client would be totally different. But what basically matters is the bottom line numbers, wherein the gross marginal number of your company is up to an industry standard or an acceptable number within an industry standard, which is sustainable in the long run, right? So that is a very key critical point, which is also very important for potential investors to look at you as a target, or acquirers to look at you as a target. The third important thing is that as a company, the kind of valuation that you look at could be in different angles, right? There are different methods out there. Industries, I mean, I don't have to give you all those numbers out there, but I'll share with you a very common thing. There is an EBITDA-based valuation method, which is basically your profits and the multiples of it, which is basically what is used in the IT industry for any product companies on a larger scale. But from a services company, there are different methods that you can usually use. So from my perspective, if I may be very candid with you people, and I want to be candid with you, the previous year before my acquisition was not so a good period for me. So if I were to be looking at the EBITDA multiples of the previous year and then basing my valuation of that, I wouldn't have sat here with a good number and with a good smile on my face. But then my current year and the current run rate that I was enjoying with this company as a customer on board, along with a few others, were also pretty good in numbers, right? So there was a forward valuation done in terms of my pipe, and based on a X value on top of that, which was basically the valuation method we used here. We based it off a book called Duff and Phelps, and there was different valuation methodologies listed there. A good valuation number in Duff and Phelps cited 1.25 to 2.5 base for any service company on a forward valuation methodology. And my numbers were somewhere around in this, right? And that's the reality, guys. And for service companies, you wouldn't be getting, like the Carestacks where you got 10x or 25x or as a product company. That's different. But from a services company, this is what I got. This is the bandwidth from where I got. I cannot divulge the numbers here because of confidentiality agreements that I've signed. But this is the reality. And for me, looking back at things from where my friend said, you should probably aspire at 3.5 or 4.5x times to where I'm sitting right now. And I think that I've taken a very mature decision there, and that has helped me in shaping up the future of my rest of my career. Suri.
Suri, you're on mute.
Yeah. Oh, yeah. Thanks, Deepu, for actually grounding us all, the service companies, bringing us back to earth. So, but what you said actually makes sense. That's quite enlightening. I'm sure it is good information. What about the product side of things, Mohammed? What would you like to add to that?
Suri, yeah, we in fact had an advisory panel who was actually expert in finances. In fact, I was not expert in financial modeling, and we are in very initial phase of the product journey. We had done it based on next 5 years projection, and this person has did a discounted cash flow kind of mechanism. They have used discounted cash flow kind of mechanism, which based on future projections, the valuation was being done. So that's how that's the information which I had on valuation.
Okay. Arjun, Gautam, would you like to add to this?
I can. The only one thing I would add. So Deepu's completely agree with what Deepu said. The one additional thing I would add there is, I think the timing is really important. So all said and done, valuation is influenced by the sentiment also, right? And so if you are on a growth path, I mean, if you are growing, so if, as Deepu said, he had not done very well in the previous year, but had done well in the recent year. And if you can project that growth, so based on your balance sheet and numbers, and if you can show that you are on a growth path and provide a good story around it, then you are likely to be able to get a slightly better valuation. And in our case, it really happened. I mean, if we had not been acquired at the exact time that we did, the next year was actually not very good for us or for the industry. And we would have ended up, if that decision had not been taken, wasn't fast enough or wasn't strong enough, we may have ended up in a very different boat, very different situation. So that, timing and taking that decision and moving it fast, I think is a critical thing. And like Deepu said, you would call it a mature decision, because you may not get that large X, but if you didn't do it, you might actually end up in quite the opposite direction. So that timing part is the only thing I wanted to add.
Okay. Arjun?
Yeah, I'm very, I wasn't very familiar with the service company investment also. Thanks. That's very insightful. From a product company, so this is different. So when we talk about valuation, we're talking about two kinds of valuation, right? So are we talking about a valuation for an acquisition, or are we talking about a valuation for an growth equity infusion, right? So for an acquisition, you're basically valuing the company as it is today, right? Now for us, or also in Mohammed's case, when a product company is raising funds, we are talking about getting capital so that we can basically build growth. And it's unfair to judge the organization based on how much revenue or how much there is in the balance sheet today, right? So the important tool becomes the financial model. The financial model becomes pretty much the end-to-end. The financial model will have how we have grown historically, right? If historically there has been growth, or there has been business, but more importantly, how we are projecting the growth from today to the next X years, right? And from there we basically decide on what is a factor, what is a primary factor on which valuation has to decide, right? So is that factor based on certain kinds of assets you're procuring, things like data, or things like certain amount of brand equity that is irreplaceable. That is typically applicable for B2C models where winner takes all. That's kind of why a cred has a very insane valuation, or a Paytm, or a e-commerce, B2C e-commerce models have a very insane valuation because it's a winner takes all market, right? For us as a B2B business, we were very clearly looking at our very clear factor was revenue, or annual recurring revenue. Right. So the variable became very, very evident. So now the question is, what is the multiplication factor, right? So how much do we multiply it by, and what do we multiply? So again, we're talking about annual recurring revenue, but at what point do we take the annual recurring revenue, right? So what we have done, and this again might not be the same with everybody, what we have done is have a multiplication, have a multiple of our future ARR. When I say future, we're talking about 12 months, 6 to 12 months upfront. And we were able to negotiate that because we had a pipeline of growth within the system. So we had a pipeline of customers and growth already completed. So we are, at least for the last few rounds, we are able to basically negotiate off a future ARR when we fulfill the existing pipeline that we have. So that became one factor. And then we're talking about the next factor in terms of how much do we multiply it by, right? And typically product valuations go from 4 to 5x all the way to 20x, 25x, right? Depending on multiple factors. And again, that we are somewhere in the double-digit range. And that is again determined by a series of factors, right? So that is determined by one, what are your metrics? So as a SaaS company, there are certain industry metrics that has already been defined. So the important thing there, once there's a financial model, the next important thing there is to make sure we calculate and we present or we modify the right SaaS metrics. So for example, for us, again, for a SaaS model, we're talking about the gross margin on a unit customer level. We're talking about what is a cost of acquisition for a customer versus the lifetime value of a customer. So that tells us against $100 we spend to acquire a customer, how much do we make over a lifetime, right? And what is that ratio? So the LTV CAC ratio became a very important metric. The gross margin percentage became a very important metric, right? Unit economics became a very important metric from the perspective of how much time does it take for a customer to break even. And then we're talking about qualitative metrics, right? So is there a market leadership that we can achieve where we get a very unfair advantage in the market and we are able to do things that, let's say, nobody else isn't? Typically these go around, these happen with in industries where data is a commodity, right? Where if you are able to be an industry leader, you have the data that nobody else has. So all of those come into play. Those are the things that we can use to really negotiate a higher value by painting a very large growth picture, right? And obviously executing it, but thinking about and painting a very large growth picture. So both these quantitative and qualitative metrics come into play when we negotiate the multiple. So that's how we arrive at a multiple, and that's how we arrive at the number to multiply it by, which in our case is 6 to 12 months of future ARR.
Thanks, Arjun. So yes, as expected, this is not an easy topic, but it's great to hear different perspectives. And within a group of 4 companies, we have probably 3 different ways of doing this. or four different ways of thinking. So that's to be expected. Let's quickly check the time. I think we got 20 minutes left. So before we go to the next slide, let us go to some Q&A session, and let's have questions from the audience. I'm sure there will be many, and then we'll based on time we'll continue on the remaining slides. Anyone with questions, please raise your hand in the chat. And, Vishnu, you can proceed with that. If you don't have any questions, we can continue. Okay. Vishnu, let's go to the next slide. So this is, in my opinion, a very important aspect to consider in any kind of investment or acquisition. In fact, before even we start thinking about investments or acquisitions, we need to make sure that are there or all our ducks in a row as far as governance, compliance, and legal areas are concerned. But that is that's just theory for me. So we'd like to hear from you guys. What are your challenges? What are some war stories that you have? Anyone can go first. Deepu.
Yeah, I can go. So to be fair, I've burned my hand here, especially on the compliance side of things. So post the letter of engagement that we received, we moved into this due diligence phase, wherein we started organizing things internally for our M&A partners to take a look at and do a due diligence internally before we present it to the other side of the table, right? So there were a lot of things out of place that that we unearthed during this exercise. And arguably, yes, this was expected because, as a homegrown company, you were basically creating stuff on the fly while, you were trying to generate revenue, and then you were trying to pay out your employees, you're trying to run the day-to-day activities of your business, right? You tend to overlook the fact that, governance, compliance, and legal in your company plays a pivotal role in, organizing the pillars or the foundation of your business, right? And this struck me pretty bad, and I burned my finger here. We basically had to go back and fix things rather than go forward and accelerate the closing part of the deal, right? So what this basically means is that not every time is it that you get an opportunity to go back and fix things in the past, but I've been blessed that I was able to go back. But my humble advice to all of you guys is that very simple things like it could be a PF related thing, or a PF compliance thing, or it could be a simple thing as your leave handbook, right? A leave handbook that basically is out of place from the general rules out there in the labor market, right? What does the shops and establishments say in terms of the leaves that is applicable for a Kerala-grown IT company? Is that in sync, or are you away from it? Is there a deviance, right? Or it could be a very simple thing. Let me think off my head. Something like have you had employees who have now eligible for gratuity, right? And have you been accruing leaves for them? I mean, what is the gratuity that is payable to them? Have you been doing actuarial valuation? Stuff like that. These are things that were all new to me, and this popped up only when I started moving into the compliance side of things. These are things that are good to have, and before you call yourself investment ready or acquisition ready, it would be a good thing to create a checklist of items that is needed. And there are many checklists out there, right, on the internet that you can actually fork into. Get those checklists and take those items one by one and say that, okay, I am investment ready, I am acquisition ready, right? Otherwise, people like me who had to go back and spend more time and money to get things fixed up, and then go back to the acquirer and paint a happy face and tell them, I've fixed it. Now can you come and acquire me? It doesn't look good. So my humble advice to all of you guys is that focus on this. These things are very minimalistic. It needs the minimalistic of your attention. You can find easy access to people who can actually service you on these. The cost on these are very negligible. Get that done. Get these things out of your way. Suri.
Okay. Great, Deepu. Great to hear that, and good to see that all worked out in the end. So,
yeah.
Anyone else? Mohammed, Arjun?
So I can add some to that. So like Deepu, we have also kind of learned things the hard way. We have also burned our hands, but in a slightly different manner. So what happens is we obviously, the one thing is we have to make sure the general day-to-day compliance is kept very clean, right? So there is an investment that needs to go in to ensure everything day-to-day, all the way from your regular payroll compliance to statutory and legal compliances in whatever territories that we are is happening. So that's an ongoing thing. For us, it has been comparatively the easier thing to do. For us, where we burned our hand is especially when we are talking about specifically the investment transaction or the larger structure in which we structure our entire operations. So what, and this is more applicable for companies which have a cross-border element, right? So when we're talking about, so we are a US-based company with an Indian subsidiary with Indian founders and US investors. So a lot of compliance has came in play, which is compliance that is related to both investment as well as operations. So for example, when we raised capital, there was a lot of, we had to go and rework on a lot of things because there were laws that said a company with a certain structure can only raise capital from this manner. Or if a company raises capital like this, India will not allow a subsidiary. So these are FEMA and FDI compliances and draconian RBI laws coming into play, right? This became a huge headache. So how we got out of it, or how we made sure at least we rectified that mistakes and repress that going forward, is to ensure we had experts in these areas, in compliance areas, working with us, not just for current transactions, but also future contemplated transactions. So we were making sure we created structures in place. We learned compliance ourselves to ensure we are able to structure this and things we want. So the easiest, like a lot of product companies today in India is going through this. So in India, one of the laws is you can't have a foreign company invested by Indian founders to have an Indian subsidiary. So India does not want money going out of India from investors going to some other country and then that country having a subsidiary in India or subsidiary anywhere else in the world for that matter. So we had to structure, now that when that law is there, that pretty much makes it impossible to do business in India, right? So then people found out an alternative to get, instead of money being invested, shares being gifted from one party to the other, things like that. But there are experts in this, and this is not none of these problems are very unique. It's just that we should know enough to ask for people who have gone through these transactions and probably done it successfully or probably burned their hands. That has kind of helped us in the past and helped us redress the problems we made in the past. As founders, what happens is as founders, we always are very aggressive, and a sense of urgency is a very important entrepreneurial skill, right? So especially in an investment transaction, we want it done yesterday, or in a compliance setup, an organizational structure, we want it to be done very quick in the simplest manner possible. There is a balance to be gained between the sense of urgency and between making sure that, we don't have to spend more opportunity costs and more money later fixing a problem, right? So from that perspective, unfortunately, there's a necessary evil. Compliance has to be considered a necessary evil, and we have to spend the entrepreneurial time on that so that we can actually, whether you can access the capital we have raised or access the capital we have personally gained, right? So from that, so that's one thing. The other thing is ensuring structures are correct. So again, this is more from a cross-border perspective, especially if we are talking about most product organizations today are cross-border, including businesses that operate in India are still having to go outside and set up their headquarters, right? So ensuring revenue management, revenue collection, and revenue recognition is done in the right manner. Thinking about where to store IP so that there is no major taxation problems later, and also thinking about what is the right structure from an exit. And an exit might happen 10 years down the lane, but especially for a product company with a very, very sizable exit, and that's a goal. However hard, that's a goal. So however, to create a structure that makes sense for your potential acquirer. So that means if it's hard for a certain industry to invest in a company in India or acquire a company in India, then we'll have to think about which geography to really position it in, right? Is there a tax haven or a tax indirect tax issue that happens, if we structure it in one country over the other, things like that. So we have to think about that structure all the way to both in daily operations and at an exit point of view from day one, which seems seems like a very boring thing to do, or seems like a very unnecessary thing to do when we have a lot of other business growth activities to do. But this will ensure we don't spend more money reworking on things or saying no to an opportunity.
Okay. So the biggest takeaway for me from this, Arjun, is that you not only have to be concerned about the Indian compliance, but also the rules and regulations of your acquirer's jurisdiction, right? Whether it's US or Australia, UK, whatever that is, right? So right. That is also something to think about as you embark on this journey. So,
correct. Yeah.
Yeah. Okay. Anyone else wants to add to this?
Just one thing. Tax is one of the areas that I think is important to look at. So FEMA, I think FEMA already Arjun covered, and whenever you have a foreign entity, either in a relationship where of doing business with you, or in a relationship where they're invested in you, or whatever it is, right? I mean, those compliances are extremely important and difficult if you haven't done that on time. So if you have a foreign entity or individual involved in any manner, then I'd suggest all of us take special care to make sure that all the FEMA guidelines are well adhered to. And that can be done easily, have the right kind of auditors or specialists looking at it. But one of the things that we, even with all the support that we had, one of the things that we got, we had to really deep dive into was something called PE tax. Okay, PE tax is, it doesn't, so it's when you send a person on site, let us say, to do some work for somebody, and he's on site for 6 months. Then there is something called PE, or a permanent establishment, which gets created in that country. And there are rules relating to PE where it says, okay, how many man months of being in that country would constitute a PE. And if it constitutes a PE, then there are some tax liabilities and documentation, etc., that you need to file in that country. This got missed totally because we were filing all the taxes that we need to do here, but we weren't very cognizant of taxes that might occur in a country where we are doing business. where we did not have an office. I mean, we may not have had an office at all, but it would still constitute some tax liabilities. So there are some such things which will come up when it goes through a due diligence and compliance related checks. So it'd be, I mean, I don't think you can completely, I mean, take care of everything. That is probably not possible at all. But it would be, if you are looking at that route where you are trying to go for an acquisition or of some sort, especially if an acquisition by a larger company, I think it'd be important to keep yourself abreast of all the important tax laws. That's the only thing I wanted to add, other than what others have already said, which are all, just as equally important points.
I just want to add to something that Gautam said just now with personal experience, guys. So from an income tax compliance perspective, if there are any notices pending in your company's name, or if there is any summons that is received by the CA or auditors, in which case, before the acquisition, my finance team was basically confined to a very small area, and most of it was done by my CA. Some of the times, we do not give it adequate enough importance, and the CA misses to actually, address these notices on time and stuff like that. These will stay as non-compliance, and very close to where you start to close the deal, you find out that there is something pending like this. Then you'll have to go to the income tax office's, office, start to, sit around his table, start, pestering him, trying to figure it out, and then, it puts us in a whole different perspective. So if there are any notices pending, anything that requires your attention, see that it is cleared, because these things might take a longer time than usual. Another item I also want to focus is that did not happen in my case, but I've been told by my M&A partners that many of the times, being the busy people we are, sometimes we even miss our, as entrepreneurs, we even miss filing our personal income tax things, right? And that is a big non-compliance in the investment bar acquisition world, right? So if you need clearance as shareholders of the company to be transferring shares or getting acquired or anything of that sort, you need to have clearance from the income tax department too, right? And for that, they will check your history, and if there is something pending, it'll stay hanging for a very long time. So please do focus on these items as well.
So I just had one last thing. If somebody has to take at least one thing out of my conversation, the one thing that I would recommend, the largest thing I would recommend is that if there is a plan to raise capital, sizable capital, right? So at least more than $5 million. And if there is no reason to absolutely be in India, please plan not to be in India. Please plan to structure your business entity outside India. Because just in the last 12 months, I have seen at least 3 startups within Kerala having to shut down their businesses in India or shut down their entity in India and then restart their an entity outside India, flip the structure, go through a very, very painful process, an expensive process, which has a lot of risk. And in most of these cases, they had received advice that you would have to don't do this in India, do this outside. But I think from a convenience sake, they chose to do it in India, right? And then they had to flip it over, which became a very expensive and risky thing to do. So if especially product, if you're a product entrepreneur who is going to raise significant amount of capital, and the problem we are attacking is not very specific to India, please plan to be outside India and create a structure that surrounds that. Even if it's a little more costly upfront, it will definitely maximize opportunities for raising capital or closing a round which have already raised and moving forward. Suri, you're on mute.
Yes. Thanks, Arjun, Deepu, Gautam. So that's quite some interesting advice. I'm sure that was very meaningful for a lot of people who probably are not thinking about these issues right now, but focusing on the product, the service, and the basically hunting for investors, right? That's great advice coming from you guys who have gone through this. Well, I think we are just run out of time. So I know, if any one of you have more questions on this, please send us a mail, and we can send it by the panelists and see what what we can get from them. At the same time, Vishnu will be forwarding a feedback link for this session. Please spend a few minutes and give us your feedback. It's extremely valuable so that the next sessions can be catered accordingly. But first I'd like to thank all the panelists for taking the time and sharing your experiences. And I'm glad that there is no PE tax in this case, which is personal experience tax. So in my opinion, so it's all free. Thank you very much, and thank you all of you who have spent your afternoon with us.
Thank you, Suri.
Thank you.
Thanks, everyone. Bye-bye.
Bye.